Are you happy where you are now? If I could have all the money in the world, money was not an issue for me. I have everything. What does your life look like? Tax optimization. So typically the structure needs reviewing. It's not to say that the accountant has done it incorrectly.
Neela Alum Isfahani, founder and family wealth advisor at ZDO Wealth Partners. Her passion for legacy creation and philanthropy drives a collaborative approach that integrates financial strategy with purpose, delivering long-term value and impact.
Banks have been pulling back for the last 5 years.
What are some of the younger generations now wanting to invest in?
I want to make sure that the wealth passes through generation in a tax-efficient manner, in the right structure manner.
Hi, Neela.
Hi, Will.
How's it going?
Extremely good, actually.
That's good.
Yeah.
That's good.
So it's been a good start to the year for the business. The market-wise, it's been a bit volatile, so it's been a turmoil.
Okay, interesting, because we're pretty much at the end of February now.
Yes.
So 2 months has passed, and another month to go until the end of the quarter.
Correct.
Yeah. So really interesting to see how the quarter plays out. What's your view?
I mean, there's been a lot of things sort of boiling under the surface for a while. So one of them is that there's been a blow up of private credit because banks have pulled back in terms of lending. So private credit opportunities have just increased. So that's been the biggest asset class that has grown enormously over the past couple of years. Mm-hmm. And generally what's been happening is that they've been shifting the risk from private banks to the private markets. That's created a lot of uncertainty. That's created a lot of risk or a lot of inquiries from a regulator's perspective because some of these loans are not marked to market. So, for example, if you lend on a dollar basis, if there's a risk on the borrower, you should technically be adjusting the value of that loan. But because you're a private lender, there is no requirement for you to do that.
So there's no regulation.
There's no.
Are there regulations that govern private lenders, or?
So they don't fall under the same rule as the banks.
Yep. Okay.
So they fall outside of it.
Right.
So essentially, what will happen is that there will be a consolidation within the industry.
Okay. So let's talk about Australia specifically for now.
Yeah.
So what are the usual suspects that require private finance or private credit?
So typically a borrower, I mean, your first point of call is the banks because they're the cheapest.
Mm-hmm. And are these business owners? Are these investors? Or
they could be developers, they could be business owners. So typically developers and business owners are the two key.
Uh-huh.
And so because the banks are pulling back, so the banks have been pulling back for the last 5 years, that's created a $1 trillion industry. Private credit always existed. It's just not to the extent that it is at today.
Right.
And the banks have continued to illustrate that they are not willing to step back in. So what's happening is that the riskier portion of the lending is being transferred to the private markets.
Right. So just for, in layman's terms, what would be deemed as the higher risk components or that banks won't touch?
So businesses, in terms of whether they are securitizing against real estate, are they securitizing against a balance sheet, a revenue, a P&L? So banks are wanting to do less of that. Mm-hmm. So that's called direct lending, and they are wanting to do more of assets that are backed by real estate.
Right. Okay. So if a business owner, let's say they're a startup and they want to go to the bank and they want to borrow X amount of dollars, unless they put up collateral in form of real estate, banks say no to these people.
Absolutely.
Okay.
Absolutely.
Okay. So those are the people that need to go get private credit.
Private credit. And private credit wouldn't necessarily say yes to these people anyhow.
Uh-huh.
But private credit tends to be a little bit more stringent. So borrower, and you are paying a higher higher rate. You're paying anywhere between 7 to 15%, and sometimes 20% on these loans, but they tend to be more short-dated loans.
So that's obviously a growing segment of the market.
That is a growing segment of the market, and that will continue to grow.
Yeah. Private credit space, who do you see are the winners globally, and who do you see are the riskier credit providers?
So typically it will be in firms that have resource, firms that have the ability to step in if a borrower were to default.
Let me ask you this question then, because you just mentioned it. So how can a typical investor take advantage of this growing market? So where do these private credit lenders get their money?
Through the private markets. So the investors are made up of 3 cohorts. One is the institutional investors. So these are your sovereign funds, endowment funds, super funds. So they're one cohort.
Yep.
The second cohort is the private market, which is where we operate. So these are private clients, high net worth individuals, family offices. That market is almost the same size as the institutional market. That wasn't always the same. And then the third part of the capital is from retail. So these are your mum and dads. So typically their net worth is below 2.5 million. So those are the three components.
So the retail investors and high net worths, how do they get involved, and how can they participate?
So sometimes some of these credit managers, so there's a lot. There's no shy of credit managers out there. There's always a new one popping up every now and then.
Right.
There's always new opportunities. So sometimes they raise capital directly via the investors. Sometimes they go through advisory arm.
Right. Okay.
So they raise
financial
capital.
Financial
planners, investment advisors, investment firm, etc.
Right.
So there are different channels that they will use to raise capital.
Okay.
So as an investor, there are about 600 credit managers in Australia. Just to give you numbers.
Okay.
How do you choose which one is good? It's extremely difficult. How do you do the due diligence?
Yep.
So that's where the risk lies for investors is, yes, you might like that asset class. Just because you like that asset class doesn't mean that you will see the return that you expected. So the dispersion of returns within managers in the private market is quite wide.
Let's talk about your firm a little bit, because that kind of ties into my follow-up question. So just explain in, again, layman's terms, what do you do? What do your firm provide? What services does your firm provide?
So we provide 3 types of services. One is investment advice. So essentially what that means is, say you've got $10 million portfolio, $5 million portfolio, and you want to outsource that management of your asset. Perhaps you've been looking after it yourself, perhaps you've sold a large asset, and so you're looking for our expertise in terms of how do you allocate that capital, which area do you allocate it in, and how do you sort of continue to make sure that your capital is working for you. So that's the investment advice. And then the second service that we provide to largely founders and wealthy families is the succession piece. So you know most business owners do business succession quite well, I would say, but they rarely focus on family succession until at a later point.
Right.
So we help with those family succession.
Can you just explain what that means? Because I think a lot of people, they have heard of it, but they don't really understand the implications of what that actually means and what it does to the families.
Sure. So just think about a company. So you're the CEO. You might have a co-CEO, which is your partner, so CEO, and you have employees. So these are your kids. Okay. So you patriarch, matriarch, and kids.
Okay.
And your wealth sort of accumulates in your 40s and 50s, typically. That's not to say that we haven't had experiences where there's been a massive sale when an individual is at 30 or they inherit. But typically your wealth starts to really accumulate in your 50s. So that's our sweet spot of our client's age. And then towards 60 and 70, that's when they start to think about, okay, what happens when I don't want to be involved in? Well, what happens when something happens to me?
Yeah.
How do I make sure that the capital that I've worked so hard for, so you either worked really hard for that capital or you were given that capital.
Most people would have been the former.
No, I think there is a decent portion, particularly now. Yes, previously.
Yep.
Particularly now, people have worked really. People have been given. There's a lot of transfer of wealth happening to the next generation, where they haven't really worked hard. It's the previous generation that have worked really hard. So how do you make sure that the values that the first generation has then transfers to the next generation? Just like a company. How do you make sure that the next CEO has the same values and the same principles to ensure that the team is harmonious and the company is growing and there's no drifting apart. And not all employees will succeed. So just like not all children will take lead in the family. There's usually one or two that will lead and the rest will follow. So we can't expect everyone. So everybody has different tastes, everybody has different wants. So you go, how do you make sure that you counter for that? So a lot of these things are never spoken within the family cohort. Sometimes it's very difficult to bring that up. But I think our generations is more tuned to communicating with our children, but certainly the generation before us are not accustomed to relaying those information.
I agree with that.
And that's where the family success. So the family succession is happening from our fathers or parents to our generation. There's a disconnect.
Right.
But in saying that, when 20 years from now, our children lives will be slightly different to how we grew up, so their values will be shaped slightly differently. So you want to set the foundation. So if you think about a company, you want to set the culture right, the foundation right. You can make tweaks. There's no problem in making tweaks, but you never change the foundation. You don't change the four walls. The four walls remain. How do you set that? How do you set that from get-go?
Right, and that's where you come in and help.
So that's the family succession.
Right, okay.
So that's that, to make sure that you've got those values concrete, and then you get the buy-in from the next generation.
Okay.
Once they buy in, then let's say you have 4 children.
Yeah.
Right? So you need to make sure that your values are passed down to those 4 children.
Right.
And those 4 children need to buy into your values.
Right.
And they have to live it. They have to believe it.
Yeah.
It's a process. It's not something that you can have on a piece of paper.
And so here you go.
Here you go. It's not something that you have over dinner tables. It is a formal structure. It is important. There is a degree of importance laid around all of this.
Okay.
So there's a seriousness about it. So when they're young, you have these dinner conversations, but at some point, these dinner conversation becomes a little bit more formalized.
Right. Okay. So I understand that. So how do you then come in to the picture?
So we work with the matriarch and the patriarch.
Okay.
So our clients.
Yep.
To make sure none of our clients will come to us with these things already set up. So we want to understand what their purpose is for their capital, why they work so hard, what are they trying to achieve. It's great when you have, as a business owner, you've got targets. What does that all mean? is it to fulfill your ego? Is it to fulfill your need? Is it to fulfill your balance sheet? What are you trying to actually achieve? Trying to understand that purpose, and the purpose is typically tied to their childhood or the past. So really understanding what their journey is.
Okay.
So there's always trauma.
Okay. Interesting.
Yeah, there's typically a trauma behind, and people are very emotional.
Yeah.
And this can take hours to uncover.
Yeah.
And you have these interviews together, but we will interview one person at a time.
Right. Okay.
And trying to really uncover what their relationship is with their parents or their loved ones,
Right.
and that typically ties into what their values are.
Okay.
And really trying to get that. And most people have similar goals in mind. They want to make sure that the next generations look after. They're not spoiled. They're not. They don't have entitlement. So they're all pretty similar across the board. They want, they're working for them. They'll pass on the capital to them, but there's no notion of stewardship. Stewardship is not discussed. So what does stewardship mean? It means that I've worked hard, and this is this is my journey, and I document that journey. So we document that journey for the next generation to see. When you're not here, they may look at it, they may not, and we do it in many different formats because people change. So they might not want to read books anymore. They might want to watch a video, or they might want to listen to you. So various forms of capturing that journey, and really to make sure that the next generation really understands you and respect you. Once you have that, you have the harmony.
Interesting.
Yeah.
Because up until recently, what usually happens is nothing gets discussed, and then when the parents pass away or whatever, and then there's a massive transfer of wealth, inheritance to the children, and the children don't know what to do with it.
They're overwhelmed. So typically people leave it to the estate to do the family succession. So we're saying, what we're advocating is that estate is great, and that's the tangible piece of the succession planning. So that's the transfer, like physically transferring. But how do you transfer values?
Yeah.
You cannot do that on the estate.
Yeah.
Yes, some people say, well, we have dinner conversations and we're pretty close. Yes, when your wealth is at a lower point, but when your wealth gets larger and larger, this becomes a lot more important, because it's not just your children that you have to worry about. You've got their spouses.
Yeah.
They've got their own social network. They're speaking to other people.
Yeah.
And you want to control that environment a little bit more. Yeah,
because the last thing you want is your children to get married and they get divorced and they take part of it and all that type of stuff.
Correct.
Yeah.
So but the state will also cover that asset protection, which is what you're talking about. But the state doesn't cover prenuptial agreement or postnuptial agreement. It's really hard for you to. So when your kid is older, let's say 25, and she is ready to fall in love, and she's living with her partner, let's say. Yeah. Okay, and you've been really successful, and I know no doubt you'll be really successful. You've worked really hard. Say you get hit by a bus.
Yep.
She's living with her partner, and in your will, I'm trying to simplify this.
Sure.
Let's say it's 25% of it goes to her.
Yep.
So that becomes her part of the asset pool.
Yep.
Well, he will have a say in a claim on that.
Okay.
So how do you make sure? And so you want to have these conversations early with your children about prenuptial, postnuptial, so that they buy in. It's very hard for you to go to her. Yeah. And say, look, I know you're with your partner, and I want you to have a prenuptial agreement. She's gonna say, get lost, Dad.
Yeah, definitely.
I love him, and there's no way I'm going to do that, because then he doesn't want. So it's really hard.
Interesting.
So that's where the buy-in comes in. So they've got to understand your journey. They've got to respect your journey. It's not just a matter of, yes, my dad is successful, he's worked really hard. it goes beyond that. It's that respect that we're looking for.
Right. Okay. So you help sort of nurture that out of, excuse me, and put some framework around that.
Correct.
For the families.
Yeah. So you may have heard of family constitutions, family charter. So we have the family charter. So family charter is just capturing the values, so the patriarch and the matriarch values, and then the family governance dictates the process. So again, I'll come back to your company.
Yeah.
So a company will have a business plan.
Yeah.
How do you execute that business plan?
Yeah.
You will have a board.
Yeah.
You will meet this many amount of time. This is what you will discuss.
Yeah.
These are your external advisors.
Yeah.
We're working together, so it becomes a little bit more formal.
Gotcha.
And
Gotcha.
and it's up to patriarch and matriarch as to how much they're wanting to share with their children. So it's not about sharing the dollar value of the balance sheet.
Yeah.
Because often they don't want to share that. They don't want to share that. They just want to let the kids know that they've got enough.
Yeah.
There is enough for everybody.
Yeah.
But rarely do we share the dollar value.
Why is that?
I think one aspect is that there is an inclination that they might not work as hard. Business, you work really hard for the capital. You want to make sure that your children,
They don't feel entitled.
they don't feel entitled.
Yeah.
They make something for themselves. Yes, we're here to help you, but we're not here to we're not here to be taken advantage of.
Yeah. Yeah.
But we will help you.
Yeah.
And these are the areas that we will help you in. These are the areas that we will not help you in. And it's all in the charter.
I want to come back to that in a second, because this is fascinating, because I also want to understand what are some of the practical tips to obviously make a successful plan. But what's the third service that you provide?
So that's more family office concierge.
Okay.
So if you think about a concierge, it's a fancy way of saying we provide a personal assistant to the family.
Okay.
So you can have that internally. So you can hire somebody to do that.
Okay.
No problem.
Yeah.
Or you can outsource it. So we provide the outsource service.
Okay. Interesting.
Yeah.
Interesting. Why isn't this topic spoken more often about? And why isn't this taught at school? Like just financial literacy and education. Why isn't it at school, and why don't we, broadly speaking, talking about these issues?
Well, I did schooling here, did primary and high school here. I mean, it wasn't taught when I was there, but I think budgeting is being incorporated into the curriculum now. But to go beyond,
maybe only some schools.
yes, maybe.
Yes.
But there's also a desire for families to educate that, so they are sending their children to it becomes like another activity or an extra curriculum. But there is, I think the schools are being conscious of that. They are aware. So I think my understanding is that budgeting is being discussed at the high school level, not at the primary level.
Yeah.
Understanding, I don't know what the curriculum is, I haven't looked at it, but my understanding is that it is being incorporated, but at a very basic level.
Yeah.
So if you think about the people that you and I work with, so you and I work within the high net worth market. So both our clients or our customers are in that cohort. There's about, in Australia, I think it was Frank Knight's wealth report, 2025, that did this. There's about 42,000 families, or 43,000 individuals that meet the high net worth status.
Okay. What's the definition of high net worth?
So high net worth it has a balance sheet more than $10 million balance sheet.
Okay.
That includes your home.
Okay.
So more than 10 million.
Yep.
So your balance sheet is greater than 10 million.
So most of these people live in eastern suburbs would almost be higher than that.
No, I think that there's a few in the regional as well.
Of course,
but it is concentrated in the eastern suburbs.
Yeah.
But I think it's a lot more varied now. Yes, I think it started there, but it's a lot more varied. There are some in northern beaches. There's some across. There's some a lot of in regional. So if you think about farmland,
Yep.
that has
Yep.
grown. So
Yep.
real estate market.
Yep.
Just so thinking about that.
Yeah.
So it's varied.
Yeah.
Perth,
Yeah.
again, varied.
Yeah. So 42,000 out of what are we, 30 million people
27 million, I think.
now? Yeah. Okay. So
that's
point 0.01.
0.5%.
Yeah. Okay.
When I did the maths.
Okay. So 0.5%.
So that's our market.
Okay.
But that's the more greater than 10 million balance sheet.
Yes.
But high net worth will also include, so between 5 million and 10 million, it's about 100,000
Okay.
individuals.
Okay. So
according to this
it's
report.
1%. So it's 1%.
Sorry, 42,000 is 0.15%.
From one. Yes. That's okay. Yep.
90,000 plus 42,000, 100,000 plus 42,000. I think it's 0.5. I don't know.
Okay.
Yeah.
Yeah.
I think
Something
it's
like
0.5%.
that. Okay.
Yeah.
Okay. Less than 0.5%.
Yeah, so it's,
Okay.
less than 1% is
Yeah.
our target audience. So
Right.
it's not a lot.
Okay.
What was that? What were we talking about?
Just why
Why is it not discussed?
Discussed.
Because a lot of people don't fall into that category. Because it's such a small percentage.
But what about people that aspire to be the top 1%, right? And I feel like just the education system at the moment, we focus on memorization. Let's memorize the timetables. Let's memorize
Yep.
the periodic table, whatever.
Yep.
But when it comes to a matter of personal or family economy,
Yep.
money, wealth, investments, it's never taught. It's not even taught at university levels.
No.
Yes, you might have a commerce degree,
Yes.
but that's
Not
just...
everybody has a commerce degree.
No, but even if you have a commerce degree,
Yeah.
they don't actually teach
No,
you
they
a lot
don't.
of this stuff.
No, they
So
don't. They teach you corporate finance.
they teach you corporate finance, how to make money for other people.
Yeah.
Right?
They teach you how to read a balance sheet. Yes. yes.
That's right.
Yep,
That's
yep.
right. So why are we talking about it? Why has it been taught?
I think it's a lived experience. So it's really hard to teach somebody family succession. People don't take it seriously, in my experience, unless you're a motivator, you aspire to be, and one of it is there's lack of trust as well.
What do you mean by that?
I think that it's for example, people don't really value advice until they have the wealth.
Interesting. Okay.
With technology, I feel like, I work with a lot of clients and people who are self-made from an investment world, right? Not from a business lens, but they've just been accumulating money and they've been trading in the market. So the equity markets is about 100, just give or take about 100 years old in terms of maturity.
Mm-hmm.
So it's a fairly recent market. So previously it's always real estate.
Mm-hmm.
It's always been real estate.
Mm-hmm.
So if you
Land.
think about, dynasty or empires, it's
all about
your
land.
wealth is determined by land
Yeah.
and potentially gold.
Yeah. Yeah. I want to talk about gold in a second, but go on. Yeah.
So that market's changed, and then so previously you could read a balance sheet and you could make, you could buy talking about Australia, you could buy BHP or CBA and you trade and you do okay. And if you compound that and you're saving 100,000 a year, let's for argument's sake, and you're compounding at 8%, well your money's going to double every 8 years. And you're adding to it. So there are some people that have made significant amount of wealth through trading.
Yeah.
And now with the index type of investing, so not trading companies anymore, buying index, it's become a lot easier.
Yeah.
So a lot of people feel that they can do this themselves, but they don't really emphasize on family succession because, I don't know, I think...
Do you think it's a Western society thing or is it an Eastern society thing? Because
I think Eastern society, Eastern origin values family succession a lot greatly, because the main focus is that the money has to stay within the family.
Yes.
That is the key.
Yes. And Jewish families do this really well.
Yes.
Yeah.
So that's the stewardship.
Yeah.
So the money has to stay within the family. Whereas the Western is yes, I'm not saying that they are, nobody wants to give away, but it's not as prominent. It's not as, as openly discussed.
Right. Yeah.
So they're more cautious about it in terms of how they, discuss with their children. Whereas Eastern type, Asian families in particular,
Yeah.
they will openly discuss it with their children.
Yeah.
We want to make sure that the money stays within the family. We want to make sure that it doesn't, your spouse doesn't get it. It's a culture.
It's a cultural thing.
Yeah, it's a cultural thing.
Yeah, interesting.
And so it's done, but the Western type or the West versus East is that East are less willing to take risk, or what they perceive as risk.
So they're more conservative?
They think they're more conservative.
Right.
I would say they think they're more conservative.
Okay.
But for them, being conservative is real estate. So their fallback is real estate. So they can't handle volatility. If the balance sheet moves, it gives them anxiety.
Yeah.
And so they tend to fall on real estate. That is changing, whereas the West will value compounding versus stability.
Interesting. It's a very different investment philosophy.
It's a very different philosophy.
But what's also really interesting is in Australia, approximately 60% of the GDP is associated with property-related industries.
Correct.
So Australians inherently love property.
Correct.
But I feel like unless you're from a migrant family, a lot of these issues are not really spoken about or discussed. What I'm actually curious about is, from your experience dealing with many high net wealth families, what is the biggest misconception when it comes to money? Misconception about wealthy families when it comes to money?
Misconception is one. So let me understand. Misconception as in what they believe to be true.
What do other people believe to be true about wealthy people when it comes to money? That's not true.
I don't know. What do they believe to be true? They think that most people, like if I speak, they feel like they're entitled. And they got lucky. I think there is a bit of there's certainly luck. Where it doesn't matter how you made that, well, whether it be through business or trading or investment, there's a fair amount of luck that's incorporated, and that's within our investment philosophy as well at the firm level. So we recognize that there is a bit of luck involved, but there's also competency. And I think that the misconception is that they haven't worked really hard, they were given. You haven't really worked hard, you were given. That's a fairly common misconception if I speak to retail type investors or mum and dads.
That's interesting, and I think I was having a chat to one of my business coaches recently, and I think people like to obviously I wouldn't say promote, but talk about success rather than failures.
Correct.
Right.
Correct.
So everything that you see on social media,
it's all
interviews,
success.
biographies.
That's right. You're right. Actually, you're right.
It's all success, right? Very rarely do people document their failures.
Yes.
So people from the other side of the fence, they only see success.
Correct.
They don't realize
the vulnerability.
Yes.
The hard work that's required to get there.
That's right.
So there is that.
Yeah.
Absolutely.
Interesting.
Yeah.
Interesting. What do you think are the biggest mistakes that majority of people are making when it comes to wealth planning?
I wouldn't say mistakes, but I would say lack of clarity on what they're actually wanting to achieve with the capital. We want to make sure that the capital is working for you rather than you working for the capital.
So what are some of the key questions families should be asking themselves to get clarity? If I could have all the money in the world, then money was not an issue for me. I have everything. What does your life look like?
You've got no issues. So we've taken your financial anxiety away from you. Everything is perfect. What does your life look like? And work backwards from there.
Interesting. Because some people might say, well, maybe my health is not the best.
Correct.
Maybe relationship with my kids are not the best.
That's
or
always the way.
Whatever.
It's I've not looked after my health. I've not looked at. It's usually children. I haven't paid attention to my children as much as I would like to. Particularly so within founders. If you had everything in the world, if you had all the money in the world, there's not a single worry. Tell me what your life looks like. Where do you see?
Interesting.
And it's often always about relationships or health.
It's
one of those.
Fascinating.
Or sometimes it's impact.
Okay, what does that mean?
It means their happiness comes from creating an impact in a society. So that's when we start to explore philanthropy for the family.
Okay. They want to give.
They want to give. So you can give in many different ways.
Yeah. Okay, interesting. So what does a perfect client look like to you?
A perfect client is someone that is in a stage where they are ready to say, actually, I want somebody to look after this for me.
Okay.
And I'm ready to form an advisory board. So something that also families don't discount is they don't have a good advisory network.
There's what, accountants, lawyers?
It's usually it's an accountant and an advisor. So these are your two advisors that are constantly with you on a regular basis.
Okay.
Your lawyers are what I call transactional.
Okay.
So you need a great lawyer.
Yep.
But you're not seeing your lawyer every quarter. Hopefully not. But you're seeing your accountant every quarter, or at least biannually.
Right.
You should see your advisor every quarter or biannually.
Okay.
So those are your constant relation, and then the other thing that I see being overlooked is coordinating the conversation between the two. It's poorly done sometimes.
So the advisors are not talking.
So usually the clients control the discussion. So they're unable to coordinate between the two. Where I like to do with my clients, and I do this with all my clients, is I like to collaborate with the accountant. So the first thing I ask for the clients is to introduce me to the accountant. And the second thing I do is meet with the accountant. Okay. Whether it's face-to-face or virtually. So prefer face-to-face if it's allowed, and then virtually. And I think that relationship, that collaboration, active planning, because we become the two key pillars for this particular family, and working together, coordinating, and working as a team almost for the family, and that becomes the advisory board. So your advisory board will grow as your wealth grows. So you might need different type of advisory board, but you would have a constant accountant. And also sometimes your accountant, you outgrow your advisors. You might have worked with an accountant when you were when you didn't have much, when you were salaried, or when your business was merely making. You're just making ends meet. There's different levels. So it's very difficult for individuals to recognize that sometimes. Even if they recognize it, there's a certain amount of guilt that's associated with it. If they were to engage, and I feel the accountant isn't, or the clients will say, do you have a decent accountant? And we will discuss openly, because it's at the end of the day, it's the client's decision, but we will also encourage them to consider. Sometimes, not always, and it's openly discussed with the current accountant as well. So it's an open discussion as opposed to stabbing people at the back.
Don't want to do things behind the backs and things like that. Just transparency is very important.
Transparency is extremely important for families. I think transparency is across every facet. Transparency across fees, transparency across investment decision, transparency whether we hold the capital, we don't hold any capital. We are just consultant. We do not touch your capital at all. Our client's capital is held custodially by another company, and they're a listed ASX company called Net Wealth. So we transact. We're able to transact. We can't withdraw cash.
Yep.
So we've got no say. So we don't hold any capital.
Yeah.
So we are purely consultant.
Yeah. Gotcha. So what would your advice be for families who've listened to this podcast and you've got them thinking about wealth planning, succession? What's your advice to them in terms of next steps? Like what should be the first thing they do? Is it to talk within the family first? Is it talk to the accountant first? Talk to you first? And then what's your advice for them to get started in this journey?
I think talk to themselves first, and take time. Don't rush. Just maybe if you are listening to this and you're really thinking about it, just have a coffee somewhere. And what is it that intrigued you about this? Maybe write it down, and just take your time as to what you're trying to achieve, or and then work from there. You will always have a trusted person that you consult with. That can be your accountant, that can be your friend. I would say consult with them as well.
Yep.
But sometimes your trusted person may not know the right direction.
Yeah.
So not saying that they will provide you the answer, but certainly it's a starting point. But really answering the question, just slow down, take your time, have clarity on what you actually are wanting to do. If you're not sure, that's okay. That's what we're here for. And of course, you're welcome to reach out for a consultation at no charge. And I do this often. So just pick up the phone and start meeting. And just start. You've got to start somewhere. You have to start somewhere.
Be curious and just talk to
people
who's doing it already.
And make sure that the people that you are talking to are working with the people that are like you. Because your problems are not unique.
What's the consequences of not doing this? So for families who are, like founders who's obviously, been in business for 10 plus years, accumulated significant amount of wealth, what are consequences for them and their family not to do something like this?
The consequences, I would say, let me answer that by saying what we see. What we see when they come to see us.
Okay.
Tax optimization. So typically, it's their structure needs reviewing.
Okay.
It's not to say that the accountant has done it incorrectly. It's just that we've got more structures that we can look at. So it's not just super, it's not just trust, it's not just a bucket company. We've got other structures that we look at to try and optimize your tax. So that's the first key component.
Okay.
And the second one is that the assets are not as protected as they would like it to be.
Okay.
So sometimes, and again, it shouldn't fall on the accountant to do this, because accountants, unless you have advisory accountant, not everyone has an advisory accountant, so they often mix the two up. There's an advisory accountant and then there's the accountant. So unless you have an advisory accountant, they obviously charge you more because they're advising you on certain things. So typically the structures is not as protected as you think they are. And the third is, if you don't have, if you're not thinking about it, it's not that you will lose your capital, is that you're not going to optimize your return. You will either be taking more risk than you thought you're taking, diversifying that asset pool. And most of the investments opportunities are not in Australia. They are outside of Australia.
Interesting.
Whether you have access to that is highly unlikely. If you are getting access to it, you're probably not getting the top managers. You're probably getting the bottom quartile managers.
Right. Okay.
To get access to the top, they don't go out directly to investors.
Yeah.
They haven't.
Yep.
I don't know whether that would change.
Yep.
But they
They
don't.
probably don't need to.
They don't need
Because
to.
people are coming to them.
Correct.
Right.
Correct.
So, so the consequences, the main kind of three that you're seeing is not having tax efficiency.
Yep.
You're not having the right structures and asset protection, and then you're not optimizing return.
Yeah.
Risk-adjusted return.
Yeah, and the
Yeah.
fourth thing I'll say is the family succession. So maybe
Okay.
you would have heard of. I'm not sure if you've heard of the saying where the first generation makes it,
Yes.
the second generation spends it or
Keeps it, and the third generation loses it.
loses it. Yes.
Yes.
So-
Wealth. In Chinese, it says wealth doesn't pass through generations.
Yes, but we want to make sure that the wealth passes through generation in a tax efficient manner,
Yep.
in the right structure manner.
Right. Okay.
So it's not just going from selling all your assets in this entity and then distributing it. No, we want to make sure that it is passed through the right structures as well.
Interesting.
So that the next generation can optimize the tax component
For them. Yeah. Interesting.
Yeah.
Interesting. So you talked about investment opportunities. I want to talk about that. So over the next short to medium term,
Yeah.
because whenever I ask people for long-term assessments, it's never accurate
Yeah.
because no one has a crystal ball.
Yeah.
But at least in the short to medium term, where do you see the best, and you probably get asked this all the time, where are the best investment opportunities? You talked about, was it private credit a while ago?
Yep.
Is there something else that people should consider? Onshore, offshore?
It's a $1 million question.
Where are you advising your clients to put their money?
One of our principles is that we have no idea where the market is going to be. We don't play in that market. We don't even make prediction on where the market is going to be. But where we have a pulse is on the cycle, where we are in the cycle. Each asset class has a cycle. So property has a cycle, equities has a cycle, credit has a cycle, so gold has a cycle.
Yep.
So each investment has a cycle.
Yep.
Our job is to understand where we are for that particular investment, where we are in that cycle, and whether we should take position, whether we are compensated for the level of risk that we're taking. If we're not getting compensated, then we shouldn't take it. But if we feel that we're getting compensated for the risk that we're taking, and we're adequately or we're over compensated, then we take a larger position.
Okay. So what asset classes at the moment are in an optimal cycle right now?
Not necessarily. Equities, we will say, is at its high valuation.
Okay.
So there is concern around that.
Okay.
But within that equity basket, emerging markets, for example, we think there is a lot of value to be gained within that market. So
Okay.
for instance, China is the second largest economy in the world. There is no doubt China will be the biggest economy in a couple of years' time. It's on that trajectory. The G7 GDP, so these are your Western developed countries, their GDP is trending downwards. GDPs of emerging markets are trending upwards. So that's just the economic data.
Yep.
So that inflection point occurred about 3 years ago, approximately.
Yep.
Don't quote me on that, but yeah, approximately 3 years ago.
Okay.
So we think there will be, it doesn't mean that the companies won't be listed, but what you will start to see is that there will be revenue shift. So even if you look at Microsoft, for example, majority of the revenues are not just coming from Western countries.
Yeah.
They are coming from. So it's not just a matter of understanding the economic dynamics and understanding where to participate.
Okay.
So for Australian investors, your key, we have a disadvantage in terms that our dollar is a little bit more volatile.
Okay.
So if there are opportunities offshore. If we go offshore, we need to be wary of currency.
Yep. Currency volatility.
Yep. To hedge a currency, it costs, and the cost is about 1%, give or take. So managing that currency risk, it becomes important because currency can take away some of the return sometimes.
Yeah.
So whereas a US investor, for example,
Yeah.
doesn't have that issue, because majority of the investments, even emerging markets investments, are based in USD.
US dollars. Yeah. Yeah.
So
Okay.
that's our disadvantage, and that's
Okay.
something that we have to sort of work with.
Yeah. So what should we be investing in?
You should be investing across all asset class, I think,
Okay.
and then you dial up and down as to
Okay.
where the because if you take our principle that we have no idea where the market is going,
Okay.
we want to have a bit in each asset class. So we have 4 asset classes that we work with.
Okay.
One is equities,
Yep.
so owning a piece of the business. So
Yep.
that can be public or private.
Yep.
Credit,
Yep.
again, public or private.
Yep.
Real estate or real assets.
Uh-huh.
So that can be infrastructure. So infrastructure will fall into that real asset bucket. So
Yep.
anything tangible.
Yep.
And then the fourth one is alternatives. So not anything that doesn't fit the top 3.
Crypto, does that count?
Crypto, we're going to alternatives.
Okay.
Yep, so
Okay.
that will be an alternative because it's
Okay.
a currency, or it's a form of currency, digital currency.
Okay.
So that will go into alternative basket.
Okay.
Yeah.
Interesting. So let's talk property specifically.
So let me answer your
Okay,
question in
yeah.
terms of how we're positioning.
Yes, sorry.
So
yes.
we've been taking risk off the table for the last over 12 months now. So we've been de-risking the portfolio.
Okay. So where are the riskier?
So we've been
Baskets.
increasing our alternative basket. We've been increasing our private credit basket. And we've been increasing real assets. And within real assets, we've been increasing infrastructure,
Right. So you're so reducing equities.
reducing equities.
Interesting.
Yeah.
Interesting.
So
okay.
we're going more long duration assets. Certain type of real assets are long duration.
Yep.
Long duration means you're holding the asset for a long period of time.
Yep.
But within commercial property, it can be a short duration asset because you're developing a site, you're developing an aged care, you're
Yeah.
looking to sell that within 3 years' time,
Yeah.
or you're meeting a certain specific needs.
Yeah.
So that's not determined by cycle, but that's determined by what the demand is.
Yes.
So just because, let's say, real estate is at its peak, it doesn't necessarily mean that we won't participate in real estate. It just means that we might participate in a different manner.
In a different way.
Let
Let me ask you a follow-up question to the previous question. So you are taking risk off the table from the equity bucket and you're putting into the other 3 buckets. And because of that decision, obviously you're a little bit more risk averse right now, given everything, all things considered. So are you now chasing more cash flowing investments? Is that part of the mandate, or that's not a key consideration?
Cash flow is a key consideration for investors because if you think about when you're working, there's a heroin injection that goes into your bank account every month,
Right.
which is your income.
Right.
When you stop working, you still need that injection into your bank account.
But that would depending on the age of the investor, where they're at, right?
Correct.
Right.
So most of our investors are in that 50 range.
So
they're not
getting out of
they're sort
getting
of
out of
Yeah.
active.
But even then, some clients who are in that accumulation phase where they don't really need income from the portfolio, then we won't have much. We're not focused on cash flow.
Yeah.
We're just focused on optimizing the return,
Yes.
right?
Yes.
And that can be an income, that can be growth. We're just optimizing. So we're disregarding income for now.
Right.
For certain clients, we will make sure that there is a certain level of income to support their cash flow needs.
Right. Okay. So it's a broad brush sort of approach. Cash flow is a big component.
Cash flow is a big component.
What you're
However,
considering.
some clients will have a very large property portfolio where the cash flow is meeting their needs.
Mm-hmm.
So they'll come to us and say, we have a large property portfolio. We're meeting our cash flow from property. So properties are if you're holding the asset, if you're holding property for income, we'll say that's a long duration asset, right? You're holding it for cash flow more than anything else. Capital growth is fine. it's great. You want the capital growth because you want the money to at least keep up with inflation.
Yeah.
But it's really there to support the income need. Okay, well then they will say, well, we don't need you to focus on income for here. We just need to make sure that we meet our investment objective and whatever that investment objective might be.
Yeah.
So we'll structure that. Or some people will say we have a very large commercial property portfolio. So we'll say, would you like us to look at commercial real estate for you?
Mm-hmm.
And we might encourage them to say, you do that, or you've got will to doing that for you.
Mm-hmm.
We won't do that in our part of the capital. We will do things that you're not doing
mm-hmm.
to complement your other parts
mm-hmm.
of the family pool.
So out of all the clients that you're servicing right
mm-hmm.
now, where are they, when they come to you
mm-hmm.
initially, where do they typically have majority of their wealth? And where do they want to diversify into?
So they may have majority of their wealth in cash, believe it or not.
Okay, because they've exited something? Or?
They've exited something and they've been sitting on cash for a long time.
Okay.
Or they have an equity portfolio, typically a domestic
mm-hmm.
equity portfolio with some ETFs, offshore ETFs like tech ETFs mm-hmm. or S&P 500 ETF.
Mm-hmm.
And then they will say, look, this is where we are. Can you please optimize it? So, what is the risk? So for us, the risk is that you've got 100% of your investment in equities.
Mm.
So you're determined by what the equity market is doing. It's a highly volatile asset.
Mm-hmm.
We still think it will continue to grow, but it's a highly volatile asset. So we can reduce the risk, but perhaps even deliver stronger returns without taking the level of risk that you're taking within equities.
Right, gotcha. Okay.
Yeah, so that, and then what we're seeing recently is the property pool, the commercial property pool.
So people coming
off.
They already have.
They already have a very large commercial, and they're looking to pass it on to the next generation.
Yeah.
And the next generation are not interested.
In property.
Not that they're not interested, they don't want to have everything in there.
Interesting.
Because, yes. So that's what we're seeing recently.
Right, okay.
And the patriarch, typically it's the patriarch thinking, how should I transition this? So we have one client who's looking at selling 2 warehouses. They've held it, I don't know, for years.
20 years, whatever.
Yeah, for years.
Yeah.
I don't know if it's 20 years, but they've held it for years.
Yeah.
Within the business, it's within a structure. And they're saying, well, maybe we should sell something.
Okay.
Because all our money is in commercial property and business.
Right. Okay. Let me ask you, this is interesting. So obviously the previous generation and perhaps our generation, we're still very real estate focused. We believe in that asset class.
Mm-hmm. Yeah.
So what are some of the younger generations now wanting to invest in? What's their kind of flavor?
Real estate, I mean, they will love to invest in real estate, but real estate is capital intensive.
Yes.
So you have to have the borrowing capacity, you have to have capital. So it's a highly capital intensive asset class.
Yes.
So you either have to put all your money into one asset, or you diversify. But you still are if you can still achieve the same level of return.
Okay.
I think the next generation is more return focused, is what I'm seeing.
Okay.
The younger generation.
Okay.
Because they're fueled by what's happening within the ETF markets, within what's happening in the news. And generally that's the gist that I'm hearing, is that they're return focused, they're not as relationship focused.
Okay. Interesting. So a lot of crypto, a lot of ETFs.
A lot of crypto.
Yeah.
We should be in there. So we don't have any young investors. But I know that's what young investors are doing.
Yeah.
And they will say, well, if I can do it myself, well, why do I need you?
Interesting, because I can buy crypto over a few clicks of a button.
Yes.
Yeah.
Yes.
And I've got all these influencers on social media telling me what to buy.
Yes. So why do you need us?
Yeah.
Right. So the answer to that question is that you do not understand what the level of risk that you're taking. Yes, you can buy it. Do we buy those? No, we don't buy crypto.
But then again, it's an age thing as well, because when you're younger, you tend to be a little bit more
Fluid.
Yes.
Yes.
And if you lose it all, that's fine. I've still
Yes.
got 20 years to catch up.
Correct.
Whatever it might be.
Yes.
Yeah.
Yes.
Yeah,
So
interesting.
there is a bit of mindset. But
Yeah.
what if I reverse that and say, what if you don't lose it? What if we just compound it and be patient? You would actually do much better. Because
A lot of them don't see that.
don't see that, no. So
They don't wanna
there's a
wait.
chart in one of the pack where it says if you lose 20% of your capital, you will need to make 50% or 60% to get back to where you are. If you lose 100% of your capital, or it's even 60% of your capital, you need to make, I don't know, I can't remember what number it is.
Yeah.
But you need to make like 150% or something
Yeah.
back. And that
Yeah.
takes time.
Yeah.
So during the GFC, the S&P 500 fell 50%,
Yeah.
right? Close to 50%.
Yeah.
It took 2.5 years to get back to break even.
Yeah. A lot of people who are retiring around that time really felt it.
Yeah.
Yeah, because
Yeah.
their super just went from here to basically here.
So that's where the concentration risk. People underestimate concentration
Yeah.
risk.
Yeah.
So it's a lot more important, or it's heightened as you get older.
Yeah.
It's less concerning when you're younger
Yeah.
because you've got the bandwidth.
Yes.
That your time is on your side.
Yes.
Time is not on your side when you're 60.
Yeah.
Yeah.
Yeah. Yeah, agreed.
Yeah.
I have a bit of a selfish question. I don't know whether you can answer this or not.
Yeah.
So I'm a big commodity investor. So
Yep.
I hold physical gold and silver
Yep.
and so forth. I know that's not something that you focus on, but I'm sure you would have some visibility into
Yep.
it. Obviously, silver and gold just went berserk,
Yep.
went through massive gain in 2025,
Yep.
and it's going through a bit of consolidation this month.
Yep.
What's your general view
Yep.
on gold and silver in the short and medium term?
So if you go back to the fundamentals, what's driving the price of gold to go up or the price of silver to go up?
Just devaluation of currency, fiat currency, right?
So that's one component.
Yeah.
The other component is the debt. There's lots of debt, government debt, that's floating. That's the second component. The third one is, the fiscal policy, so fiscal spending.
Yeah.
So there is still a lot of fiscal spending that is promised by the governments across the world, not just Australia, US, across Europe, and these has to be funded by something. A lot of it will be funded by debt. So
And the
there
debt
is
needs to
no.
be backed by something, right?
At the moment, the debt is not. So US is the only country that can print unlimited amount of debt. Unlimited amount of currency.
Currencies, yeah.
We cannot. Australia cannot. We cannot print money willy-nilly because our currency will devalue,
Yeah. Yep.
which is what happened in countries like South Africa,
Yeah.
etc.
Yeah.
The reason why US can print it is because they control USD.
Yes.
And they control USD through trading route.
Yep.
Now, countries are saying we will buy oil in our currency,
Yeah.
not in USD.
Yes.
So the Saudi Arabia petrodollar contract was not renewed. So some of these is driving the factor that USD, it's not, you won't be able to control the USD as much. It's not going to be as relevant. I don't think it would disappear, but so that's what's driving the cryptocurrency market and driving gold and silver.
Yeah.
We do play in commodities.
Okay.
So we do own gold.
Okay.
We do own silver.
Okay.
But we took that position, and we do have we don't own crypto because it's
It's too volatile.
It's not that it's too volatile. No. Is that there is no fundamental behind it apart from the fact that
pure speculation.
Yes.
Yeah.
Yeah. Whereas gold is a finite amount. We know where it is. So crypto is we consider it as speculative.
Yeah. Some people would debate you on that.
I'm sure they will. I'm sure they will.
When it comes to Bitcoin specifically.
Yes.
But no, that's fascinating. So my personal goal is like you said, real estate is very capital intensive. So my philosophy, I don't know whether it's right or not, is as I'm earning money through the business, I park the money in commodity. Once it gets to a certain level,
Yep.
million, 2 million, whatever, then I cash out and buy real estate.
Yep.
That's what I'm doing right now.
Okay.
Is that good or not?
That's one strategy.
Okay.
That's a strategy. What
Yeah.
happens if so that's assuming that gold will grow at 8% or
Yeah.
but there was a period where gold did not do anything.
No, true. Gold and silver didn't do a lot
It was just flat.
for 20 years.
It was just stagnation. It
Yeah.
was just stagnant.
Yeah. But
So
I think
you might come out of it. So it's a timing.
it is a timing thing, but I think generally speaking, it is a deflationary asset, I believe,
Yes.
in the long term anyway.
Yeah.
But in the short term, I feel like all the things that are happening in the US right now, there is a big push to drive gold and silver prices up in the short term.
Yeah, I think that there's merit to that.
Yeah.
Yeah, there is merit to that.
Yeah.
But again, they're cyclical. So it's a cyclical asset. So there's a fundamental that's driving it. If that fundamental changes, then we change our position.
Yeah. All right. So a couple of final questions. We covered a lot, and it's been a really fascinating conversation.
Yes.
I'm going to ask you this just to kind of like, you don't have to answer it, but what's the returns that you've been giving your clients in the last year and the year before?
Every client portfolio is different.
Okay.
Okay, because like I said, some clients will say we don't want to participate in equities because
Yep.
we don't like volatility.
Yep.
There are some clients that don't like volatility at all.
Uh-huh.
They can't sleep at night.
Yep.
So we don't have any beta.
Okay.
Okay.
Okay. But you've made money for your clients.
Yes.
Okay.
Yes, we have. We've met their objectives, but however, our investment team track a portfolio.
Okay.
Like if it was a perfect client, and they gave us complete authority to do what we wanted, and we call that the best ideas portfolio or our high conviction investment. So if you had $10 million, where we will put that $10 million? How will we allocate it? So we're capital allocators. We allocate capital accordingly. And that portfolio has been tracking about just around, so last calendar year 2025, we did 14.96%.
Okay, score 15.
Yeah, and then the year before we did that. But that's not to say that, that's what we're targeting. So this particular portfolio, we're targeting about 10%.
Yeah.
But with the vault, so that our Sharpe ratio has been quite strong, and we publish this on our website, so you can have a look on our website.
Yep.
We don't tell you exactly what's in the portfolio because that's our IP.
Yep.
But we publish, sort of our tracking
Yeah.
record.
Well, it's very healthy returns.
It's been really healthy returns. Our investment team, in terms of our experience, we have institutional experience and private market experience. So our investment team have managed billions of money before. So the investment team is very well resourced. And as a result, we do get in front of some of the managers, some of the investments that otherwise might be unknown. Not difficult, but sort of under the radar. And we really focus on backing. We really focus on how much the manager is managing. Depending on what asset that they're participating, how much they're managing is really crucial, because that will tell us whether they can deliver the alpha. And we use a proprietary system where we track the managers. We don't want to pay for you just to track the beta meaning market.
Yeah.
Anybody can do that. Yeah. We want to pay for alpha, which is what is it that you're doing that's driving the return. And so we have AI. That's where AI has come in.
Yeah, great.
So and we're able to do that the way, but we are relying on the managers to provide that data. But we're able to demand those data. As an individual investor, there is no way you'll be able to
No.
well, it's just very difficult. Well,
Yeah.
the cost would just amplify to buy the software, to then have the relationship with the manager. It becomes almost impossible to execute unless you're a family office where you've got $500 million. You might as
You have your resources.
You have the resources.
Yeah.
That's right. That's
Yeah,
right.
understood.
Yeah.
Yeah, great.
Yeah.
Well, Neela, so where can people find you?
You can find me on LinkedIn. You
Okay.
can find me.
What's your handle on LinkedIn?
I don't know. That's maybe the wrong way to say it, but
But-
you can.
So just type your name in
Just,
LinkedIn.
yes,
okay.
I think there's only one Nila Alam Ispahani. I don't think there are two.
Okay. Well, we'll put a link in our
Yes.
description.
But you can send me an email directly to myself, so Nilar, Nilar at Zeteo Wealth, Zeteo Wealth.com. Or you can just search me through your LinkedIn profile, and I'm there.
Okay, just find a connection from my
Find a
LinkedIn.
connection, yeah.
Yeah, no, it's
Yeah.
great. It's been a great podcast, Neela.
Thank you so
Very
much.
eye-opening, and hopefully we'll do the next one soon.
Thank you so much, Will. Thank
Thanks,
you.
Neela.